So welcome to our webinar, Preparing to Sell Your Business. We are very excited to have you here, and we're going to get started. So the first thing, some general information. So please locate the chat box that is located at the bottom of your screen. And go ahead and write something to us. Say hello, say hi, say your name if you'd like to, or if you don't want to say your name, that's totally fine. I just want to make sure that you're able to locate the chat box that is at the bottom. Okay, great. And I just want to make sure that you're actually seeing my screen. Okay, now we see the screen. Thank you. Okay, hello. Yes. Okay, great. So now also locate the Q&A box. Next to the chat box, there is also a Q&A box. That's where you will write your questions, and we will answer them as we go. We will also leave time at the end to answer those questions. So if you see that box, that's where you enter your questions. This is an interactive webinar, so we're going to stop for questions. We would love your comments and your feedback. So use those two, the chat and the Q&A, in order to communicate to us. We are definitely going to maintain privacy, and in terms of when you're asking your questions, so you want to chat, your name, you don't have to say your name. We're not going to announce your name as we're asking those questions, because we know that some people, when we're looking at selling or buying businesses, we want to keep the privacy there. And we're going to give you a survey at the end of the webinar where we'll ask you to give us your feedback of the information that you received today. And we're also offering a free consultation, whether with myself or Bill. And all you need to do when you get a survey is to click the box where it asks you if you would like to get a free consultation. All right, so we start by introducing ourselves. My name is Klevit. I'm the co-founder and CEO of Business Success Consulting Group, and we specialize in process documentation and improvement. And Bill?
Hi, I'm Bill Patten, and we specialize in selling businesses, and as part of that, doing valuations of businesses.
Fantastic. All right, so why are we here today? We're here to give you the rules of selling and buying businesses during these times, the times that we're experiencing right now. And why us? Well, Bill is the top 1% broker in the entire world. This is worldwide. And he also owned a few businesses. He sold, he bought businesses, and he's been through different economic climates. So he's definitely very versed on how to survive and thrive during those times. And I have also experience working with many businesses, helping them systematize, document, and become more efficient. Our objective for you today is that you walk out of this webinar with a list of things that you need to do in order to prepare your business for selling, and that you also walk out of here with a better understanding of what it will take and the preparation that is needed. Our agenda today is Bill is going to go over those actions. He's going to explain what will it take to get the business ready for selling, and then I will introduce some concepts about systematizing and improving the efficiency in the business. And with that, I'm going to stop sharing right now. And Bill, over to you.
Thank you, Adi. And I appreciate you all taking your time out today of your schedule to join us. And I think you'll find this to be a good use of your time. Our goal is to talk about how do you prepare your business to for sale right now. Much of what we'll be talking about applies all the time, and some of it is specific to the impact of the coronavirus. And I'm sure that's on everyone's mind. We'd like you to ask questions, so as you have questions throughout this presentation, just type those in the chat box, and Adi will share those, and we'll address them. So let's get right to it. How do you prepare your business for sale? So what's the goal of the session? Understand the business sale process. What makes your company marketable? What's the value of your business? What are some of the legal issues to consider? What are some of the tax implications? We'll primarily focus on value and marketability and preparation. I'm not an attorney and I'm not a CPA, but I have been through enough of these that I have a pretty good idea of what things you're going to typically run into. So let's first start with perspective. Here's how a business owner typically sees his company. It's beautiful and everyone thinks it's beautiful and cuddly. Here's how the buyer tends to see your company. They tend to see the flaws and they'll be happy to point those out. So it's important for you as an owner to look through the lens of someone else, look through the lens of a buyer and see how is the public going to see my company, the public being the people who are going to come look to possibly purchase my company. Here's the process from a 10,000 foot level. First, start with evaluation because it's critical to understand what's the value of your business. We find that most business owners don't understand that. It's not their skill set. They've never had to. But it's important to find out what's the value before you make an informed decision if you're ready to sell or not. The price may be very important in that. Then decide how to market it. You could market it yourself or you could utilize a broker. And there's some issues on both of those to consider. Once you decide to take it to market, then of course marketing material needs to be created. Once you have that done, you need to advertise both to strategic buyers and into individual buyers. Those are really the two large buyer pools. Once you find a buyer, they'll submit a letter of intent. This is a non-binding agreement, but it's really a handshake saying, I want to buy your company. Here's the general terms. If that's accepted, then you move to negotiating a purchase agreement. And once you're through that, and there's a couple of other steps we'll get into, then close the sale. So that's really from the 10,000 foot level. So let's talk about valuation. And part of perception versus reality. What is the reality of your business? I talk to a lot of business owners who they don't know what their business is worth, but sometimes they think they know what it's worth. And often, almost always when they have that opinion, they think it's worth more than what the market's really going to reward them for. So it's important for you as a business owner to really understand reality. What is your business worth? And to do that, you really need to talk to someone who's an expert in knowing how to do that, has experience. And so it's really a component of cash flow, which we term as seller's discretionary earnings. We'll get to that. Or EBITDA, some of you may be more comfortable or more familiar with that approach to cash flow. We look at SWOT. What are your strengths, weaknesses, opportunities, and threats? We look at risks of your future cash flows. And then we need to prove the cash flow, and then we need to look at opportunities. So really three primary components of value. Cash flow, it's a really critical one. Risk, and from the buyer's perspective, risk of that cash flow continuing on into the future. And then the third one is opportunity. What opportunity is there for a buyer if they're going to buy your business? Because you're not going to find a buyer willing to move forward unless they see an opportunity. Those are really critical. We look at it and say, does your cash flow support the price? It's not uncommon for me to hear a seller say, Bill, I need to sell my business for $1.5 million. That's what I need to retire, or that's what I believe it's worth. So then we look at your cash flow and say, does your cash flow support the price? Because your cash flow has to go to primarily really 5 places. It has to go to a salary of the buyer, because they need to pay themselves a reasonable wage. It has to go to debt service, and debt service is really a function of price and terms. It has to go into CapEx or capital reinvestment, because every one of us has to buy equipment and invest capital in our businesses every year. And then the buyer should expect a return on the investment from their down payment. Just so they can invest in your business, they can invest in the stock market, whatever they invest in, they are going to expect a return. And then there needs to be a cushion for them. And a cushion is so that if they run into a speed bump the first year or two, they don't go out of business. Banks require that. So if you, and typically that cushion is between 20 and 35% of cash flow. So we look at it and say, what's the total company cash flow? In this example, $535,000. Here's how it's utilized to support a price of $1,560,000. Here's a situation where the cash flow is only $475,000. You can see the cash flow is not large enough to meet the needs, to meet the cash flow requirements. Therefore, it doesn't support the price of $1,560,000. Also, size matters when you're looking at a business and you're looking at what's the value of my business. This blue bar here is owner compensation. You can see it's about the same for each of these three. CapEx, roughly the same. It's a little bit bigger on this one. I'm just making some assumptions. Not every business is the same as far as what kind of capital investments. But you can see the larger you get on profitability, the more cash there is available to allocate towards debt service. The larger you can make this green bar, or the free cash after owner compensation and capital reimprovements, the more cash you have for purchase of the business, it drives the price up. Then you can look at, do I go FSBO, or for sale by owner, or with a broker? What are the pros and cons of doing that? First off, having an interested buyer is not the same thing as having a ready, willing, and able buyer. Our word for it is we have to kiss a lot of frogs before we find the prince when we're looking for buyers. There's lots and lots and lots of people who think they want to be a buyer. They think they want to be a business owner. That's not necessarily true. Or they don't understand the risk. They don't understand the cash flow. They don't understand their own appetite for risk, or often their spouse's appetite for risk. So you have to be able to sift through the interested buyers to the real buyers. You have to objectively define the price, which if you sell it yourself, you may or may not be able to do. You have to objectively defend the price, not only to buyers, but also to financial institutions. A broker can be an emotional buffer between a seller and a buyer, and that can be very important. And also, a broker allows a business to focus on operating their business without distractions. It's not uncommon to have a business owner decide they're going to sell the business themselves. That becomes a fairly significant distraction, and then their business suffers. So I'm not saying that selling it yourself is not a good way to go. I know some people who've done it successfully. One of my businesses, I did it myself successfully. This is about 30 years ago. So there's value that brokers bring. But if you're a business owner and you already know a buyer, maybe it's a competitor or someone you're aware of who's expressed interest, you certainly can go that route too. As brokers, we charge a fee, of course. We need to bring more value to the table than the fee we charge, or really, frankly, you shouldn't hire us. So we work hard to bring value more than what we charge. You got to put together marketing materials. I won't belabor that point, but that's critical as you're bringing it to market. And then you have to be able to identify buyers. And you've got private individuals, you have strategic buyers, and you have investors. Those are really the three primary groups, and you have to know how to reach those people, reach and present. Once you find a buyer, the goal is to get them to submit a letter of intent. And it's really a handshake. It's the general terms of the deal are laid out. It's non-binding, but it's a significant emotional step. In our experience, about 95% of the time that a letter of intent or an LOI is presented and accepted by the seller, those deals go through and complete. Occasionally they don't, because usually it's because a buyer gets into their due diligence after this step and finds things that they don't like, or the seller starts learning some things about the buyer and they decide it's just not a great fit. But most of the time, once you get a letter of intent, it's going to go through. Then you move to a purchase agreement. This is the binding agreement, the legally binding agreement. I highly suggest that you have some legal help in this, some legal advice, and There's all flavors of attorneys. You want to use an attorney who has experience in doing business deals. I would say that the less that's discussed in the LOI period, the greater trouble during the PSA period, or the purchase and sales agreement. So it's important in the LOI to make sure that you both have a clear understanding of the general approach and the price and the terms. In the PSA, you get into a lot more of the details. And I'll say this too, attorneys can be deal makers or deal breakers. You've probably all met with, you've all met some deal makers and some deal breakers. There's some very good attorneys who know how to do these deals. They can do them efficiently. They're really not that expensive. I've also run into some attorneys whose primary goal is to ring their own bell and charge, you know, a lot of hourly fees that frankly are not very necessary. And then we get into funding. There's not many cash buyers out there. And so there's almost always a financial institution involved in loaning money to the buyer so they can make this deal happen. And right now, and for the last many years, the primary source of these funds are SBA loans. Now, with the COVID-19 issue, SBA loans have become a completely different animal than they were prior to it. Because as you're probably well aware, SBA banks now are just buried working on PPP loans. SBA loans for the acquisition of businesses are called a 7A loan. And the 7A pot of money is in the same pot that PPP loans are. So as you can imagine, there's huge demand for PPP loans. And so that's where banks are putting their time and attention. And we as brokers need to find a bank who, and we know some banks, that have bandwidth and willingness to work on 7A loans during this crisis so they can actually fund. There's one thing to find a buyer, it's another thing to get funding. And frankly, there's a lot of banks who will not give you their priority or their time and attention to do a 7A loan right now. And then the question is, can your sale be financed? Because if it can't be, likely won't be a deal. Just some quick outlines on SBA requirements. The SBA requires the buyer puts down a minimum of 10%. And that's 10% of the purchase price plus operating capital that they and the buyer determine is needed. And that's really to get through the first 60 or 90 days. They also require the buyer has industry experience, although that's very broadly interpreted. Seller does not have to carry a note. You may hear this a lot, that the seller is required to carry a note. The SBA does not require that. They do strongly encourage it. And also, the SBA doesn't loan the money. The banks loan the money through the SBA. So you have SBA rules, and then you have bank policy. SBA rules don't require that a seller carry a note. Most SBA banks, they do require that a seller carries a small note. Typically 10% is what we see a lot. I've seen 5%. I've seen 25%. It really depends on the bank. It depends on the seller's willingness or interest in carrying a loan.
Bill, we have a question. Do you mind if I interrupt you for a second?
Please do.
Okay, so we actually had two questions. So to the audience, if you have a question, please put it in the Q&A box, then we can see it immediately. The question is, how have funding options changed because of COVID-19? What are some of the other funding options business could go through because of COVID-19? Because you mentioned about the SBA being tied up.
Sure. Yeah. So the way it's changed is that really the availability of the money and the banks willing to take the time to focus on prioritize doing a loan for your buyer. So the money is there. The SBA, I talked to the SBA regional director a couple weeks ago about this, and he said they absolutely are holding some money for SBA 7A loans. They know how important that is, for the economy. But the fact of the matter is, it's the banks that make the loan, not the SBA. And so it's down to, are the banks willing to? I've talked to a number of banks who so far have not been willing to put the time and effort into a 7A loan. They will later, but they're just going to put you off.
Got it.
few
Okay.
banks who will focus on the 7A loans for you. So you have to find the right one. That's part of what a good broker can do for you.
Right, and I know you have those connections and understanding of who they are. The other question that was asked is, what exactly is debt service? And that was a few minutes ago.
Okay. So debt service is your loan payment.
Okay.
And so clearly that's a function of how much do you borrow. Let's say you borrow $1 million. And then over what number of years? An SBA loan is typically a 10-year note, 8 or 10. They can't go past 10 on a 7A loan. And then what's the interest rate? It's really a function of those. What's the price? What's the interest rate? What's the number of years you're amortizing the loan over? And then part of your other question was, what are alternative options for funding?
Right.
Banks don't like to do commercial lending, just standard commercial lending for the Bank Act for purchase of businesses. The reason is level of risks. Banks are allergic to risk, as I'm sure you all know. They want collateral that they can put their hands on in case this deal goes bad, and they can get whole. That's their whole priority. If they're going to loan money, is they want to be secured so they can get whole. But most business sales have a great deal of goodwill. They don't have there's not enough assets in the business to make the bank whole if the deal doesn't go through. So that makes banks very nervous. That's why they do SBA loans. It's at the SBA guarantees 75% of the loan. Banks only taking 25% of the risk. And so there are banks willing to do these deals at 25% of the risks. And the fees are fairly high for the buyer. So what other money is out there? Primarily seller notes. And I'm sorry to tell you, business owners that, but there's a swing right now in the last couple of months towards sellers having to carry all or a substantial portion of the note if they want to make the deal go through right now.
Got it. Okay, good. Thank you. And if that answers your question for the two people that asked us, please in the Q&A box, just say yes, and we'll close that question. And if there are more, then I'll come back and ask you the questions, Bill.
All right. Yeah. Thanks for asking. Those are good questions. And please feel free to jump in. I know it's easy on these webinars for me to just talk and talk and talk. And I'd love to get your questions because I know it can get very boring to just hear someone droning on and on. And I want to answer your questions. I'm sure you have some as we go through this.
Sure. Good.
So banks will finance, essentially, the short answer is 90% of the deal. They can finance up to 90% of the deal. The buyer has to bring a minimum of 10%. So the entire thing can get, so when you sell your business, you potentially can walk away with 100% of your money at closing. The more typical scenarios, you get about 90% of your money at closing, and then you carry about 10% for a few years. I find most sellers are perfectly willing to do that. 90% is a substantial amount. To close the sale, you have to negotiate your way through the PSA because there's a lot of details in a PSA that have to be defined about a deal. We always use an escrow agent. Attorneys can act as escrow agents, but title companies also can too. You want to get an escrow agent who is versed and familiar with closing business deals. Business closings are significantly different than real estate deals. And escrow companies, the vast majority of their business is closing real estate, of course. But there are escrow agents who are very good and very experienced in closing business deals, and it's very helpful. They make sure all the T's are crossed, the I's are dotted. They collect the money, both from the buyer and from the bank, and they disperse the money. They make sure everything's done properly before the money's dispersed. So it makes it a lot less problematic and risky for all parties. So real quick, what makes your company marketable? There's really two ways to sell it, a stock or an asset sale. I'm not going to get into those differences, but it does make a difference on how marketable it is. What's the financial performance of your company? What are the non-financial aspects of your business that are either positives or negatives? And we'll get into those a little bit. And what's the financeability? Financeability really has to do with your cash flow. Are you profitable? I often run into, or fairly often run into sellers who call me up and say, Bill, I want to sell my business. I say, terrific. Tell me about your business. Tell me about your sales. So what were your profits? You go, oh, well, we didn't make money last year. What about the year before? No, we lost a little money then too. Pretty darn hard to sell a business that's not making money. I'm sure that's not a big surprise to you guys. We take a deep look at the value. What's the value of your business? And that's a question all sellers have on their minds. And determining value is not just a science. It's really a combination of science and art. What's the cash flow? But then what's the risk of that cash flow happening in the future? Because looking at your cash flow is a historical look backwards. The buyer's looking forward and they say, okay, so you did that last year and the year before, but can I expect that to continue? And why can I expect that to continue? Prove it to me. And really, the level of risk determines the multiple of cash flow you'll get. Most people have heard you get cash flow times X. Cash flow times 3 is a number I hear all the time, which is, you know, sellers call me and say, oh, I heard I get cash flow times 3. What's cash flow? But I can get 3 times that, right? Well, no, not necessarily. The average small business sells for 2.92 times cash flow, close to 3. But the key word is average. That means some get 1.5 and some get 3.5. It's all about risk. And you've seen this slide before, but I bring it up again because it's really, I can't tell you how important this is. It's made up, the value of your company is made up of cash flow, risk, and opportunity. Therefore, when you're getting your business ready to sell, you want to look at all 3 of those and say, I want to make my cash flow as strong as possible, of course, that's a no-brainer. I want to look at the risk issues from a buyer's perspective and shore those up. And then what are the opportunities? Most sellers that I talk to, they know what the opportunities are. They haven't had the time or the interest or the energy to go after it, but they have a pretty good idea what the opportunities are. You're selling the future cash flows. You're not selling your history. History is important, but again, future cash flows. What is cash flow? I've had that question come up a lot, and I can't get into all of it, but basically, how much cash is being generated by your business that benefits you, the owner? And that's a different number than the profit on your tax statement. Most business owners I know, they want to maximize the amount of cash flow they get, but they want to minimize the taxes. And therefore, what the tax shows as profit is not how much cash has been generated benefits the owner. And I don't need to go into the details of that. I'm sure you all know how that's done. But, you know, we do take company profits. We add depreciation and amortization because those are not cash expenses. We add your interest because the buyer will not have your interest. They will have their own interest. And then we look at owner perks. And some owners get very creative with owner perks and some play it very black and white, but we look through those as well. Here's where you get into some issues about.
Bill, we have a question, if that's okay to interrupt you.
Absolutely, every time.
Okay, so the question was, my company's bottom line has suffered because of the COVID-19 shutdown. How would that affect my company's value and the ability to sell?
Excellent question. So many of you probably have gone through this COVID-19 and suffered. I know, you know, some businesses have thrived, a few of them. Some of them have been going along okay. Most of them have been hurt somewhere between badly and terribly. And that's a great question. I've talked to a number of banks. I've talked to valuation companies about this. Their perspective is they think, you know, the COVID-19 is really a blip, a painful blip for sure, but it's not indicative of how your business has performed over the years. And it's likely not indicative of the future. We don't anticipate having another one of these in the future. So for the most part, they and we will look at that as an anomaly and not ding you for negative cash flow during that time period. That said, we're also going to have to look, and I know banks are looking at this, how did you do during the COVID-19 crisis? Were you able to bounce back and recover? If you were, they're going to look at it as an anomaly. But if you have not been able to bounce back and your cash flow stays down and your sales stay down, that is going to negatively impact your system, or sorry, your value. On the other hand, if you thrived during COVID-19 and you've come out the other end stronger, that is going to increase your value. So COVID-19 certainly is going to have an impact on how buyers and banks look at the value of your business. So it could be a positive, could be a negative.
Thank you.
You're welcome. So here's some of the things that impact the cash flow multiple. What's your customer concentration? Do you have 80% of your business with one client, 50% with one client, or is your largest customer 5%? The smaller the concentration, the less risk. What industry are you in? Some industries get paid bigger multiples than others. Manufacturing, for instance, gets a higher multiple than a janitorial company. How good is your accounting system? Are you up to date? Is it clean? Is it accurate? Is it believable? What kind of management tools do you have? Do you have a good estimating system? Do you have a job costing system? Do you know where your costs are going? Do you have an MRP system if you're a manufacturing company? Then look, what are your barriers to entry? We'll talk a little bit in a minute about barriers to entry. Location can be an issue, or can be a factor. And what's your trajectory? Is your trajectory up or down? We'll go past this one. So look at barriers to entry. You should know what the barriers to entry are to your business. In other words, how do you protect your business against your competitors? How do you protect your top line, your sales? How do you protect your gross margin? Because your competitors are always nipping at your sales, and they're always nipping at your margins. And what do you do to protect those and keep those strong? Those are important. Can be quality, can be a management team, it can be culture, it can be a patent you protect, or an IP. It can be your employees, often is your employees. Location, capital, you keep your equipment up to speed. Is it good? Is it old and held together with baling wire? What kind of service do you provide? Those are all things that help protect your business. The more you have, that's going to make your business more marketable. We want to look at the trajectory. So if this is what your history looks like, that makes it relatively predictable for a buyer, as long as they don't go in and screw things up, and no buyer plans on doing that. On the other hand, if you have erratic sales and erratic cash flow, that's very difficult to predict, and you're going to get discounted on your price because of that. Or perhaps this situation where your cash flow is trending down, that of course is going to give buyers and banks pause, and they're going to ding you for that. How strong is your management team? Do you have a management team? Is your management team your whole family? Then what's the risk of them leaving when a buyer buys it? Do you have high turnover in your management team, or have they been there for many years and they're very solid and competent? Management team is very important. We talked about customer base, family concentration. The more family, the more risk to a buyer. Culture. Culture is driven by the owner and the CEO. What's your culture like? And a healthy culture is usually reflected in profitability, and so is an unhealthy culture. That's going to be important for a buyer of what the culture is, and is it a good fit for them? Processes and procedures. Do you have good processes and procedures? Do you have any processes and procedures documented? The more that you have these identified, clarified, and documented, the easier it's going to be for a buyer to come into a business they don't know and run the business and run it well right from the beginning. Because if these are not documented, a buyer is going to have to figure out what the processes are, what the procedures are, and how do you go about implementing those. So the better you have these defined and documented and implemented, the better. Facilities, what do your facilities look like? That's the first impression is important. So clean your facility up, clean your inventory up, have it be organized. If it needs a little bit of lipstick on the pig, do that. I just sold a business. It was a manufacturing company, and when you walked in, it looked like it came out of the 1950s. Nothing had been changed for decades, and it was worn and looked like an unmade bed. It was a good company. They just put no time and effort into the appearance. The buyer came in, and I went back and visited him 2 months later, and I didn't even recognize the company. You walked in, and fresh paint, fresh look. They did quite a few things just to make it appear better. To many buyers, that's important. And it's important in part because they feel it's important to clients. When you bring clients in, first impressions are important. So look at your facility from the eyes of a buyer walking in, not from you walking in for the last 20 years. And you'll probably see some things you can do just to spiff it up and organize it and make it look better. Intellectual property, make sure that you have, if copyrights or patents or trademarks or trade secrets are important, you have those in hand. I did have a deal once where we had a buyer very interested, and the seller had forgotten to get a trademark on their most important item. Killed the deal. So of course the seller then went back and got the trademark, but the buyer had gone by then. It takes a little time to do that. One thing that we want to be clear when we market the business is, what's your product? What's your service like? What's your price point? Are you a high quality, high price? You low quality, low price? All of which are reasonable strategic purchase to the marketplace. But what is your company's position in the marketplace? What are your warranties, and how will warranties and guarantees be handled after the sale? Because a buyer will certainly be responsible for fulfilling those, and how is that going to be handled? There's ways to do it. Legally, warranties stay with the seller, but practically, if you have a client of the seller who comes into the new, after the sale is completed, they come in and say, hey, there's a warranty on my product. It didn't, it hasn't held up. I need you to honor that. Practically speaking, buyers have to, if they want to keep their reputation. So, is your business ready to sell? What can you do to better prepare? And what resources do you have to make the necessary changes? I would strongly suggest you bring someone in from the outside who can help you answer those questions and give you a perspective that we often don't have when we're in the office every day. At the end of the day, people are your biggest asset, and buyers know this. So one thing to look at is your people. Are they happy? Are they competent? Are they capable? Are they efficient? Do they like working there? That's usually reflected in turnover. So buyers will look at turnover. I'll look at turnover. And if you have high turnover, that's typically a warning flag about some deeper issues. Not always, but it usually is. And so it's important because they are your biggest asset. And do you have a Debbie Downer, or do you have a Johnny Raincloud you've kept in your company? And this happens so often that there are people, that owners have kept someone that either the company has outgrown, or they made a bad hire and never really dealt with it, and they just kept them on because they're okay, but they're not really that great, or they're problematic but not big enough problem that you can get rid of them, or maybe you feel like you can't get rid of them because they may sue you. Those are the difficult issues that business owners have to face every day. The stronger your employee base, the better it's going to look to a buyer. And frankly, it reflects on your bottom line. This is just a piece of business philosophy I like to share, but it of course does impact value, because this is the bell curve of company cash flow. And the average is right around 8%. Not that terrific. Some are closer to zero. Some are up in the 20, even 30% range. And I'm talking businesses in the same industries. And the question is, why can a business make 30% or 20% and another business in the very same industry, even in the very same marketplace, only make 5% or struggle to make any profitability? And this was shared with me by a business owner who's a Greek immigrant who was highly successful, started his own business, and ended up selling to Xerox for a significant amount of money. They kept him around to run the division for a while. And he shared this with me. And he said, Bill, the difference is the willingness of the business owner to make difficult decisions. And those are usually personnel decisions. You know, if you're making 8% and all of a sudden your profits slide back to, 4%, 2%, 1%, you'll work like hell to get it back to 8%, and you'll make whatever decisions you have to make, and you'll make the hard decisions. But will you make the hard decisions to get to 20%? I find most business owners won't, but I also find those opportunities are often there. They can be raising prices. It can be difficult employees you've never dealt with. It could be inventory problems. It could be systems you need to invest in to get it there. But it's something to consider about, because all of us as business owners are faced with decisions every day, some of them very difficult. And making those difficult decisions and making the correct decision really helps move your profit margin higher, makes your business more valuable. A couple things that I often run into that are problematic for business owners, and it becomes problematic in trying to sell your business, is estimating tools. Do you have a good estimating tool? Do you go back after you do estimates? Of course, this is for companies that have to do estimating. Do you go back and double check your actual experienced expense against your estimate to make sure your estimates stay accurate? It's shocking to me how many companies don't do that. Let's say the majority don't. So they continue to use an estimating tool that they haven't actually proven to be accurate. That hurts in number of jobs you secure. It hurts in your gross margins. So I would take a look at that. Do you have a job cost system? This is more for job shops. Do you know what your actual materials and labor are for jobs? And if so, it helps you price jobs in the future, helps you manage the efficiency of your company. It drives more money to the bottom line. But it also really helps a buyer. If they come in to look at a company, you've got a great estimating tool, you've proven it, you have a job cost system, you know what your costs are, and you can prove it. That is really great information for buyers. So just real quick, how much you can end up with at the end of the day if you sell your business is not just the price. So most businesses are sold as an asset sale rather than a stock sale. So you're not selling the stock of your company, you're just selling the assets of your business out of your corporation to another buyer, and they're going to transfer those assets into their corporation. Buyers like that because they're not then acquiring any of your pre-existing liabilities. So in this situation, you would get a price of $1,560,000. You would get $1,560,000 for the sale of the business. You would also then keep the cash you have. You would keep your accounts receivable, but you'd be responsible for paying off your accounts payable and other liabilities and your long-term liabilities. In this situation, the price was $1,560,000, but the owner walked away with $1,722,000 before taxes. And so that's something to consider as well as you're looking to sell your business, not just the price, but what will you end up with? That's more important. At the end of the day, you want a willing buyer, you need a willing banker, and you want a happy seller where everybody wins. So that's the presentation. And Dee, I'll send it back to you.
All right, great. Thank you, Bill. That was very, very informative. And I'd like to remind our audience that we are open for questions. So go ahead and type your questions, and questions came in. So we would like to get all of them. And now I'm going to go into a short presentation about documenting processes and procedures. That's my area of expertise. And as Bill mentioned throughout his presentation, that one of the things that is important is to have well-documented processes and procedures. And why is that? Well, I'm going to tell you why, and also give you some pointers of how to document those processes and procedures. So the first thing here, as you can see on my screen, why processes and procedures? Increase efficiency leads to profitability, and that will definitely increase, the bottom line and the financials that you're going to show. And it's also risk mitigation for the buyer. It gives transparency, stability, and continuity. How do you engage of a project like that to document the processes and procedures? It might sound overwhelming, so that's why obviously getting outside help always helps, and that's what we are here for. But if you want to do it yourself, where do you start? The question to ask is always, where do you start? You look at your company as an entire, you're in the entirety of your company, and ask yourself what area, if you had well-documented processes and procedures, will get you the biggest return on investment. For instance, you might have an area that is proprietary to what you're doing and a potential buyer won't know what to do. Document that. Maybe you have employees that have been there for a long time and the uncertainty whether they're going to stay or not, or regardless, let's say they're staying, but it's still documenting that knowledge is very important. So that will be an area that I will start with. So you just have to analyze and decide which area should you start with. Then you need to map the process. After you map the process, you're going to get it done. Basically, that's where you start on the project documentation. Utilize your team. Don't do it by yourself. Figure out who on your team would you like to clone, who knows how to do things the best, and utilize them in this project documentation. And also, after you utilize your team, you assign them assignments to write those processes, review those with the leadership team. And that's a great opportunity to create the improvements that are needed. Every single time that I engage on a project documentation, on a process documentation project, we always find things that need to be improved, things that need to be maybe can done a little bit differently. But the main thing is not to try to change before you actually have it documented. You document it, you see that there is consistency, and then you can streamline it to make sure that they are working well. And what's the difference between success and failure in terms of having processes and procedures is getting them implemented, is making them accessible to all. So in order for you to do that, you need to make sure that your staff is aware, first of all, aware of those processes and procedures, or even before that, you have to make sure that they're well documented, that it's not just a piece of paper or a Word document where you just type and type and type, you know. Utilize the different ways that people like to learn. Utilize videos, utilize audio, utilize interaction, meaning, you know, you write something in the process and you tell somebody to go do it, to look at it, implement, use screenshots, use short videos. I mean, you can, a video of yourself, but also, or the person who is doing it, or the actual activity, but also short videos of screenshots or things you're doing on the computer. It helps tremendously. It breaks the monotony of just having it written, but it also makes sure that it is accessible and people are going to use it. Because that's the main thing. You want to make sure that those processes and procedures are usable and that they are actually being implemented. And with that, that's my section. And now let's go into the Q&A part. So again, if you have any questions, type them in the Q&A box. And before we do that, what I'm going to do is I am, as I said earlier, and Bill, if you want to, you can look at the Q&A box. We have questions there. I am going to now put in the chat box a link to a survey. So if you can open that link that I'm going to put right away in the chat box. Here we go. So go ahead and open that link that I put in the chat box. And that's a quick survey to give us feedback about the content. And also if you'd like a free consultation with either Bill or myself or both of us, just click that box and we'll contact you. Okay.
Adi, there's a question.
Yeah.
Can they get my slide deck? The answer is yes.
Yes.
But we need their email.
Correct. So just write it in the survey. So open the survey, enter your name there, and it will ask you for your details. So then at the end, where it says anything else, just say, can I please get the slide deck? And we also recorded the webinar, so we'll be happy to share the recording as well. So just make sure that in the survey that I put in the chat, that you actually write down that you would like that slide deck, and we'll be happy to email it to you. Okay.
There's another question about what are the key points to selecting a broker when you decide it's time to sell?
Mm-hmm.
I would say trust between the seller and the buyer is very important. You'll be working closely together. you'll want to make sure that they have experience and know what they're talking about. A key would be having them determine value of your business and be able to defend it and support it. It's actually quite surprising how many business brokers I've run into who don't know how to do that. And it's very important because they have to not only be able to defend that price to the buyer, but they have to defend it to the bank. And if they can't do that, it's going to be difficult to close a deal with a buyer unless they're savvy enough to come up to their own conclusions on price.
Right.
And you certainly have to defend it to a bank. And typically, most buyers also don't know what a value of a business is, but they know how to negotiate. So they may not know that your price, let's say your price is $1.5 million of your business. The buyer may not know that that's what it's worth, but he'll come in and say, I'm interested in this business. I like the business. I'm going to offer you $1.1 million. They may not know why they offer $1.1 million, except it's less than $1.5 million. So as a broker, our job is to defend that $1.5 million to the buyer, help them understand, no, it's not $1.1 million, it's $1.5 million. Here's why it's $1.5 million. Here's the cash flow. If you operate this business just like this previous owner, here's how you'll use this cash flow. Here's how much excess cash flow you'll have. Here's why $1.5 million makes sense. So also experience with, the broker should have experience with banks, should have some good banks in their back pocket they can bring to the table who know how to finance these deals. The other thing that we get involved in very heavily is with recommending CPAs or tax advisors, really, and attorneys. Because I've seen the attorney bill go, typically for an asset sale, a fairly straightforward one, it's going to be $3,000 to $5,000. I've seen it as high as $35,000 for the very same product. I had one large deal I did last year where the legal fees for the seller were over $300,000, but that was fairly silly. They just depended too much on the attorney and not enough on their broker and not enough on their own common sense.
Makes sense. Okay, good. All right. So those were all the questions that came here, and thank you very much for attending. I just sent you the survey. It's in the chat, the link to it. So you're welcome to fill it out, and we're going to send you the link, the recording, as well as the slide deck. And here are also our contact information in case you'd like to contact us. I'm just going to put it on the screen right now. There you go. So thank you very much for attending. And thank you, Bill, for all the information.
You're welcome. Thanks for hosting it, and I appreciate everybody who took the time to listen. I hope it was helpful.